Today, I want to share my thoughts on a new consultation published by the Bank of England and the Prudential Regulation Authority titled Modernising the Liquidity Policy Framework. Consultation Paper CP5 released on the 17th of March 2026. If you want to read the document yourself, you can find it on the Bank of England website under PRA consultations. It's an interesting publication and, in my view, an important signal of where liquidity regulation is heading. As someone who works in liquidity risk and treasury management, what stood out to me immediately when reading the paper is that the Bank of England is not simply trying to increase the amount of liquidity that banks hold. Instead, the focus is shifting towards something much more practical, which is the usability of liquidity. Now, to put that another way, regulators are beginning to ask a slightly different question than they have in the past. It's not just about how much liquidity a bank holds on paper. The question is whether the bank can actually turn that liquidity into cash quickly enough during a crisis. Now, that shift in thinking clearly reflects the banking stresses we saw in 2023. Those events highlighted just how quickly liquidity pressure can build in the modern financial system. Depositors today do not need to queue outside branches. Funds can move instantly through online banking and mobile applications. And what this means is that bank runs can occur at digital speed, sometimes over days or even hours. Against that backdrop, the consultation starts to make a lot more sense. From my perspective, the Bank of England is responding to that reality by asking banks to think more deeply about the practical execution of liquidity management rather than just the theoretical measurement of it. Now, to understand the shift that's taking place, it helps to look at how liquidity regulation has traditionally worked. Historically, liquidity frameworks have focused heavily on the stock of liquid assets that banks hold. Metrics like the liquidity coverage ratio were designed around the idea that banks should hold enough high-quality liquid assets to survive a 30-day stress scenario. Now, that framework has been important in strengthening bank balance sheets since the global financial crisis. However, what this consultation highlights is that holding liquid assets does not automatically mean those assets can be mobilised immediately. In practice, there can be operational frictions, market constraints, and governance delays that slow down the process of turning those assets into usable cash. So what the PRA is effectively saying is that banks need to demonstrate not just how they hold liquid assets, but that they can actually monetize those assets quickly in practice. Personally, I think this is a sensible evolution in the regulatory framework. Liquidity risk in the real world is not only about balance sheet size, it's about operational readiness. Now, another important theme in the consultation relates to the timing of stress events. In particular, the PRA is placing more emphasis on what happens during the earliest phase of a crisis. Now, traditionally, liquidity stress testing frameworks focus on a 30-day horizon. But recent banking events have shown that the most dangerous period for a bank can be the first few days after confidence begins to deteriorate. Now, deposits can leave quickly, market sentiment can shift rapidly, and banks may need to mobilise liquidity buffers almost immediately. Now, for that reason, the PRA is asking firms to place greater emphasis on the early phase of stress, particularly the first week. For treasury teams, this means liquidity stress testing becomes more operational and more practical. It's not only about modelling how deposits might behave over time, but also about demonstrating that liquidity resources can actually be accessed quickly enough. Now, a related concept introduced in the consultation is monetisation risk. Now, this refers to the risk that assets which appear liquid on paper cannot actually be converted into cash quickly enough when stress occurs. For example, a bank may hold government bonds that qualify as high-quality liquid assets. In theory, these instruments are highly liquid. If the bank has not tested repo transactions, if collateral has not been pre-positioned with central banks, or if operational processes are slow, there may still be delays in converting those assets into usable liquidity. What the PRA is asking firms to do is identify and assess these types of frictions, including operational barriers, market access, governance processes, and settlement mechanics. From my perspective, this reflects a more realistic understanding of how liquidity works during stress periods. Another important part of the consultation relates to how banks treat their safest assets. One of the proposals in the paper is the removal of an exemption that previously applied to Level 1 assets. These are assets such as sovereign bonds that have traditionally been treated as automatically liquid. Under the proposed framework, banks may need to demonstrate their ability to monetize even these assets in practice. At first glance, that might seem unnecessary, but the logic is quite strong. Even the safest assets require operational readiness in order to generate liquidity quickly. Settlement channels must work, repo markets must be accessible, and collateral must be positioned appropriately. The proposal therefore focuses on testing real-world usability rather than relying purely on theoretical classifications. The consultation also highlights the evolving role of central bank facilities within the liquidity ecosystem. The Bank of England is signalling that regularly available facilities should not be viewed purely as emergency tools, but rather as part of a broader liquidity framework that banks can access when needed. However, there is an important expectation attached to this. Banks must be operationally ready to use these facilities. That means collateral must be pre-positioned, legal documentation must be in place, and internal processes must be capable of supporting rapid access if required. From my perspective, this reflects a broader shift in how central banks think about liquidity support. The emphasis is increasingly on preparedness and operational readiness. Now, when we step back and consider the practical implications of these proposals, they are quite significant for Treasury teams across the industry. Liquidity management is becoming more operational and more integrated across the bank. Treasury teams will need to work closely with collateral management, operations, technology, finance, and risk management functions. It's no longer sufficient to demonstrate liquidity strength purely through regulatory metrics. Firms will increasingly need to show that liquidity can actually be mobilized quickly in practice. Now, one aspect of the consultation that I personally view as positive is that the Bank of England has not simply responded to events by increasing liquidity requirements across the board. Instead, the PRA is focusing on improving the usability of liquidity rather than simply increasing its quantity. Now, in my view, that is a sensible balance. Excessively large liquidity buffers can constrain lending and reduce banks' ability to support the real economy. Targeting operational readiness rather than simply expanding balance sheet buffers is therefore a more nuanced approach to improving resilience. That said, it's always useful to consider these proposals from a balanced perspective. There are a few areas where further discussion might have been helpful. Now, one of these is the issue of stigma around central bank facilities. Even when facilities are publicly available and intended to be used, banks may still hesitate to access them because the markets might interpret that usage negatively. Behavioural and market perception factors can therefore influence how quickly liquidity is accessed during stress. Another area worth considering is cross-border liquidity management. For international banks, liquidity is often fragmented across legal entities and currencies. A group may appear liquid at the consolidated level, but operational barriers can still exist when moving funds between entities and jurisdictions. There is also the question of intraday liquidity. Many liquidity pressures occur within the day through payment flows, margin calls, and collateral movements. The interaction between monetisation readiness and intraday liquidity management could therefore receive further attention in future regulatory work. Now, stepping back from the detail of the consultation, there is a broader message that comes through quite clearly. In my view, the Bank of England has produced a thoughtful and well-judged consultation that reflects the lessons learned from recent banking stress events. The central message is that liquidity resilience is not only about the size of buffers, it's about how quickly those buffers can actually be used. Now, for banks, this means liquidity management will increasingly focus on execution readiness, operational capability, and the ability to mobilise liquidity quickly when confidence begins to deteriorate. And for those of us working in treasury and liquidity risk, that represents a very interesting shift in how the discipline continues to evolve. If you found this discussion useful and you enjoyed deep dives into topics like liquidity risk, treasury management, and banking regulation, then you're exactly in the right place. This channel, the Industry Portal, is all about breaking down complex topics in banking and finance into clear, practical insights that professionals can actually use in their day-to-day roles. If you work in treasury, risk, banking, or financial markets, consider subscribing to the channel so you do not miss future discussions like this. We regularly explore topics such as liquidity management, IRRBB, balance sheet strategy, regulatory developments, and the evolving architecture of the global financial system. And if you have thoughts on this consultation yourself, I would genuinely be interested to hear them. Feel free to share your perspective in the comments below. Conversations like these are how we all sharpen our thinking as an industry. Thanks for watching, and I'll see you in the next video.